US markets have been on a historic upswing. After falling more than 30% from its peak in February last year, the S&P 500 is now up 72%. The rapid increase puts the S&P's cyclically adjusted 10-year price-to-earnings average at a level not seen since the 2000 dot-com era. In other signs of exuberance, initial public offerings are at their hottest in 2 decades. Bitcoin prices have skyrocketed in the last 3 months, while tech stocks like Tesla are seeing their market cap multiply over a short time span. Famed investor Jeremy Grantham says these extreme overvaluations, explosive price increases, frenzied issuances, and hysterically speculative investor behavior could pave the way for an epic bubble comparable to the market collapse in 1929 and 2000. And he's not the only market watcher who feels this way.
We're going to have a bear market sometime. And the question is, how do you get there? And who are the winners and losers out of that? So the easiest way to drop a bear market is you have the biggest market caps in the United States, aka technology and communication services, and a couple discretionary businesses. If their stocks adjust, the entire market goes with it.
While there can be disagreement over whether bubbles occur at all, most experts agree that bubbles are only obvious after a drop in prices happens.
There never is a catalyst. When stocks peaked in March of 2000, there was nothing that rang the bell or said, hey, this era is over. All bull markets end when you run out of buyers. The worst part about these kind of equity markets is that you won't know how bad things are till 6 or 12 months or 2 years later.
But experts say bubbles usually come with a shift in investor behavior.
You tend to have fairly rapid price run-ups, or it can be sustained price run-ups over a long period of time that is typically not accompanied by changes or improvements in underlying fundamentals. So you can think about it as we expect to get the same amount of cash flows from our investments. However, suddenly we're willing to pay more for it.
According to the professor, some preconditions for bubbles are already evident in the current market. New participants are changing the investor composition in markets. Firms are issuing more equities. There's rising investor expectation. And finally, there are expert investors that are betting against the market.
Bubbles typically have lasted over the span of 1 to 3 years. Again, it's hard to identify. Right? Where do you call the start of the bubble? Because maybe some of that initial growth path was reflecting true improving fundamentals.
A report by Capital Economics suggests that US equities may still be at an early stage of a bubble, and it may take another 30% increase in the S&P 500 to above the 5,000 level before it hits the same peak in 1999. For UBS, the next 6 months could see the index pushing above 4,000 amid optimism around the COVID-19 vaccine rollout and US government stimulus.
The economic recovery could actually be pretty strong. And in fact, I think where the street is concerned, we are all busy revising our growth estimates for the US economy upwards. If we strip out the 5 stocks and we have what we call the S&P 495, last year's returns was only about 6.5%. The value and the cyclical stocks have more room to run. We do think that the small caps and the mid caps have more room to run.
For investor Lu Cheng-Chuan, any market dip is always a good time to increase his exposure in US markets. His decision to buy into exchange-traded funds that tracked the S&P 500 and the Nasdaq last year has since paid off.
We're looking at maybe roughly 40% gains to date.
Mr. Lu has profited from major market crashes over the years by building 2 sets of funds, one for his retirement and another for stock investing.
We need to build first a financial safety net. And in my case, I built that using my CPF. It's an important emotional stabilizer, especially during market crashes.
Mr. Lu splits his investment sum into 2 as he buys into indices and holds them for 15 to 30 years.
The first bucket is to be unloaded when the market crashed roughly 25-30%. And the second bucket is to invest into the same index, but over a dollar cost averaging method over a slightly longer period of time. As long as I buy on crashes and let it just ride the wave up, these indices compound. On average, over the last 100 years, 8 to 12%.
And this macro perspective is also shared by many market watchers.
If you take a step backwards and you look at the valuations in accordance with the record low interest rates, in accordance with the 8 trillion balance sheet size that the Federal Reserve is pumping in at the moment, you would probably know that relative to the other asset classes, equities is actually not in the bubble itself, because the stock market is a reflection of liquidity, a reflection of sentiment in the future, not backward looking. So all that means that the stock market could trade in a very, very different trajectory from the economy itself.
The answer will be just stay invested. After a bubble, the market recovers. The question is just how long. So if you have enough of an investment horizon to let the market recover, then it may not even be a big deal, so long as you hold a nice, well-diversified portfolio.